In this issue, I will reveal the most effective smart money concepts to you. If you can make good use of the smart money concepts you learned today, then I guarantee that you will be able to make stable profits from the trading market. Let's get started. Today we will introduce 4 smart money concepts to you. Let's learn the first concept, the imbalance zone. The smart money concept trading plan is to enter the trade based on price action and follow the trail of big money, that is, the trail of smart money. Smart money is the party with a large number of orders in the trading market, that is, the party that can greatly influence the price trend. This can be banks, institutions, professional traders with large amounts of capital. So how do we identify the signs of smart money in the charts? So, we can identify smart money by price imbalances. When smart money intervenes, their huge order volume and driving momentum will cause prices to rise or fall rapidly. This huge candlestick chart is formed. So the area between these shadow lines is the imbalance area. So this imbalance zone is drawn through 3 candlestick patterns. The area that the shadow line does not touch or reach is the imbalance zone. For example, in the example on the right, you can see that there is no imbalance area because the shadow line has successfully filled the entire space. So how should we apply the imbalance zone when the rapid price change causes the imbalance zone to appear? We can wait for the price to pull back to the imbalance zone. Because the price is likely to pull back to test the imbalance zone, it will continue to act after filling these gaps. Therefore, we can use the imbalance zone in conjunction with the supply and demand zone to obtain higher quality and higher winning rate trading orders. For example, in this example, you can see that the price is currently in an upward trend. You can see that the price is rising rapidly here, so this area has an imbalance zone. Below the imbalance zone, there's a demand zone, so this demand zone is the starting point for the rapid rise in prices in the formation of the imbalance zone. When the price rises again and pulls back to form the second demand area, you can see that there is no imbalance area here. Therefore, the quality of the second demand area is much worse than the first demand area. The price will most likely make a deep correction. After falling below the second demand area and reaching the first demand area, it will continue to rise. So, from this example we can draw a conclusion. That is, when we are looking for supply and demand areas to intervene in transactions, we must cooperate with the emergence of imbalance areas to pursue higher quality and higher winning rate trading orders. However, we can also cooperate with other concepts to improve the winning rate of transactions. So now we come to the second smart money concept, which is liquidity. Liquidity appears at the price where traders set stop loss points. So where the stop loss points exist, there will be liquidity because the amount in orders that smart money wants to intervene are very large. So they must block and constantly look for these stop loss points to fill the number of positions they want to intervene. Every low or high point will have liquidity. We know that if the price pulls back to this area, most traders will want to intervene here, hoping to make profits along the overall upward trend. When the price reaches a high point, traders will start to arbitrage or even short. So there are stop loss orders from traders below the lows and above the highs. This is liquidity. Most traders will want to look for long trading opportunities within this range to intervene in this trending trade. If the price forms a bullish candlestick pattern, there will be a lot of liquidity, because many traders will intervene in the long position due to the formation of this candlestick chart combination. The stop loss point will be set below. These stop loss orders are liquidity. So if we see a demand zone below these liquidity, we can wait for the price to capture these liquidity and enter the long position after reaching the demand zone. Liquidity in the market has many variations. It can be liquidity formed by the same high or the same low. This is because these same high or low prices are the areas where most traders want to intervene, because these prices are suitable support or resistance levels for them to intervene. Therefore, there will be a large number of stop loss orders and liquidity above or below these prices. Here we look at a liquidity diagram. Prices often capture the liquidity of both parties to accumulate more orders. If we can understand the principle well, it can help us make profits by following smart money. For example, the price formed a high here, so this resistance level is the price at which traders would want to intervene in short. Therefore, there will be a large number of stop loss orders above this resistance level. Smart money will pull up and grab the liquidity of these short traders. When the price goes up and breaks through the resistance level, the smart money has successfully captured the liquidity of these short traders. Moreover, there will be breakthrough traders involved in the breakthrough trading orders. Their long stop loss point will be set below this price. So at this time, when smart money pushes prices down, it will take advantage of the trend to grab the liquidity of these long traders. This liquidity will accelerate the price drop, thus forming a large wave of declines. Let's continue to look at this diagram. When the price falls to this low point, there will be traders who want to intervene and go long at this low point or support level. Their stop loss points will be set below the low point. These stop loss orders are liquidity. Smart money will push the price down to grab the liquidity of these retail investors, and then pull it up. However, when the price falls below the low point, there will be short orders from breakthrough traders at the same time. Their stop loss points will be set above the price. Therefore, the liquidity formed by these stop loss orders will accelerate the speed and amplitude of price increases. The third concept of smart money is the direction of the market. We must determine whether the bulls or bears have the dominant advantage to find the most likely trading direction. Identifying the direction of the price is the first step in analyzing the trend of the chart, so that we can always pursue the maximum trading success rate in the direction of high probability. How does it work from the perspective of the concept of smart money? When the price falls below the demand area, the market supply is greater than the demand. When the price breaks through the supply area, the market demand is greater than the supply. For example, in this diagram, the price is currently in an upward trend. Whenever the price forms a top-to-top price trend structure, a new demand area will be formed. If the price breaks below the demand zone at this point, it will form a bottom-to-bottom downtrend structure. This is a trend break, which means two things. First, supply currently dominates and exceeds demand. Second, a new supply area will be formed. Then, as the price continues to move downwards and forms a bottom, new supply areas will continue to form. When the price reaches the demand area below, the supply and demand sides will fight each other. So the price may start to fluctuate sideways until one side wins, and the price will move in one direction. Let's look at this actual example. You can see that the price forms a top-to-top upward trend structure. This forms this demand area. When the price breaks through the previous high again, a new demand area is formed. When the price reaches the demand area, it does not rebound in this demand area and continues to rise. Instead, it fell below the demand area. This means that the current supply is greater than the demand, and this supply area is formed. When the price continues to form a downward trend structure with a bottom-to-bottom trend, it means that the supply currently has a dominant advantage, and multiple supply areas have been formed. Therefore, these supply areas are potential short selling areas. When the price reaches the position, we can look for short selling trading opportunities to intervene. Until the price reaches the demand area below, we must pay close attention to this demand area, because there is a lot of bullish momentum and power in this demand area. The price is likely to rebound upward in this demand area, so we can try to use a small position to intervene and go long in this demand area, or we can wait for the price to decide a certain direction before intervening. The next smart money concept is the order block. The order block, also known as the supply and demand zone, is an area where there is a lot of long order momentum or short order momentum. Every price movement will form a supply area or a demand area. For example, in this diagram, the price rises and forms this demand area. When the price falls back and reaches this demand area, we will pay close attention to the price formation to find the entry point. However, not every supply and demand zone is effective. We should combine other smart money concepts to pursue higher quality and higher winning supply and demand zones. Here are 3 key points I have sorted out to find high winning supply and demand zones. First, the imbalance zone. Second, liquidity. Third, it must be the supply and demand area formed after the trend breaks. We have just talked about the first 2 key points. Here we will explain the following third key point. A high quality demand area must be formed by the starting point of the top-to-top rising trend structure. If there is an imbalance zone and liquidity above this demand area, then this will greatly improve the quality of this demand area and the success rate of the intervention transaction. On the contrary, a high-quality supply area must be formed by the supply area that forms the starting point of the bottom-to-bottom downtrend structure. Of course, if there is liquidity and imbalance area below this supply area, it will also increase the trading success rate of this supply area. For example, in this case, you can see that the price is currently in an uptrend. You can see that this is the beginning of a top-to-top uptrend structure. Therefore, the key demand area is here. Therefore, these upper demand areas are likely to have liquidity. The price will most likely fall below these areas to capture liquidity, and continue to rise after reaching the key demand area below. Also, you can notice that there is an imbalance zone above this key demand area, so this key demand area meets our 3 key points, namely, imbalance zone, liquidity and trend breakthrough. So this key demand area is a high quality and high win rate long area. The above is the complete course of 4 smart money concepts. I hope it can help you. Thanks for watching.